Let's start with the US economy. Resilient, standing up to abuse from the Federal Reserve. How much longer can it do so?
Well, John, we've been a believer in what we call the high nominal growth rate environment. We've talked about it for most of this year. It's different from what we experienced in 2010 to 2020. A lot of investors are having trouble grappling with it. Basically, it means that with the U.S. economy growing at a nominal rate of 10% or so versus, say, 4 pre-COVID, that earnings and sales growth are going to be okay. The bar is low, 2% consensus earnings growth, and we think it's going to be met and cleared easily. And ultimately, at this point in the cycle, that's what we're at. We're at the Fed on one side versus earnings on the other. The Fed is pretty much fully priced in. We're now pricing at a terminal rate of 5%. Earnings are going to be okay. And look, the economy is growing, probably going to grow 3% Q3. Yes, it will decelerate into 2023, but it's not going to be the deep recession that people fear because there's no big structural imbalance, whether it's consumer, whether it's corporates or banks. It doesn't exist in this cycle like it did in 08 and 01.